beat across the board. Cadence Design Systems just dropped their second quarter 2026 earnings, and they exceeded consensus on Q2 revenue. They beat on non-GAAP operating margin, and they beat on EPS guidance, too.
Yeah, the numbers are huge. I mean, revenue came in at $1.584 billion for the quarter.
Right, and on the bottom line, their non-GAAP earnings per share landed at $2.11, while the GAAP EPS was sitting at $1.33. Plus, looking ahead, management actually raised their 2026 revenue growth outlook to roughly 19%. So they're targeting, between $6.260 billion and $6.340 billion for the full year.
And they bumped up the full year non-GAAP EPS outlook to like $8.10 at the midpoint. It's a really strong showing.
And it is. But as retail investors, you know that top-line numbers only tell the story the company wants you to read. Behind these flawless figures, there's a massive 17-point margin spread, a pretty heavy reliance on stock-based compensation, and, frankly, a geopolitical ticking time bomb buried deep in the risk disclosures.
Exactly. The headline beats are undeniable, but we really have to look deeper.
Right, so our mission for this deep dive today is to tear through this report. We're going to dive into the segment performance, scrutinize management's capital allocation, and really uncover the true underlying health of Cadence's business.
Because generating nearly $1.6 billion in a single quarter in this kind of macro environment, well, it definitely signals robust demand. But you're absolutely right to point toward the margins and the cash flow.
Right, because top-line revenue is vanity, but cash flow is reality, right? So let's put that reality to the test and look at the engine of this company. I mean, how efficiently is Cadence actually converting that $1.584 billion in revenue into cold, hard cash for you, the investor?
Well, if we look at the gross margins, they appear pretty stellar. You're talking about a GAAP gross margin of 84.9%.
And a non-GAAP gross margin of 88.2% for Q2. That's just wild.
It really is. To put an 88.2% non-GAAP gross margin into perspective, I mean, that is the holy grail for enterprise software.
Yeah, that's insane.
Right. It essentially means that for every dollar Cadence brings in, it only costs them about 12 cents to deliver the actual product to the customer. So when your cost of goods sold is that negligible, it indicates immense pricing power.
Because customers are willing to pay a massive premium, right?
Mm-hmm.
Since the software is undeniably critical to their operations.
Exactly.
But that sounds fantastic on the surface. But here's where I have to step in and push back a little on behalf of the retail investor. When we move down the income statement, from gross margin to operating margin, which accounts for all the everyday costs of running the business, I'm seeing a staggering spread.
Yeah, the gap is definitely noticeable.
Noticeable is an understatement. The non-GAAP operating margin landed at a massive 45.5%, but the GAAP operating margin is sitting way down at 28.4%.
Yeah.
I mean, we are looking at a 17-point spread between those two metrics.
It's a big jump for sure.
So I dug into the appendix to see how management bridges that gap, and a huge chunk of this difference is just stock-based compensation. The projections actually show stock-based comp eating up about 9% of revenue for the full year of 2026. So are we supposed to just accept that retail investors are quietly getting diluted just so tech companies can hoard elite engineering talent?
Well, I'm glad you brought this up because the GAAP versus non-GAAP debate is where a lot of retail investors get tripped up. The short answer is, yeah, you are experiencing dilution.
Which hurts to hear.
It does, but the longer answer requires looking at the mechanics of the tech labor market right now. There's a fierce, basically zero-sum war for specialized engineering talent, particularly those who really understand artificial intelligence and advanced semiconductor design.
So if you don't pay them in stock, they just lose.
Exactly. If Cadence does not compensate these engineers with equity, they will simply walk across the street to a competitor. And that stalls innovation, which ultimately destroys shareholders' value far faster than the dilution does.
Okay, I get that.
But to fully address that 17-point spread, we also really need to look at the other major factor dragging down that GAAP number, which is the amortization of acquired intangibles.
Okay, so what exactly does that mean in plain English? Because honestly, it sounds like financial engineering just to make the numbers look better.
I get why you'd think that, but it is actually the opposite. It's an accounting rule that makes the GAAP numbers look worse than the actual cash reality of the business.
Wait, really? How so?
Well, when Cadence acquires another company, they're often buying intangible assets, things like patents, software code, or, customer relationships. And accounting rules require them to gradually write off or amortize the value of those assets over several years.
Ah, okay. So that write-off shows up as an expense on the GAAP income statement.
Right, and it drags down the operating margin to that 28.4% figure. But, and this is the critical part, it is a non-cash expense. I mean, Cadence isn't actually writing a check for that amortization every quarter.
Got it. So the amortization is just a paper loss from past acquisitions. That makes sense. But, I mean, the 9% of revenue going to stock-based compensation is a very real cost to my ownership stake, isn't it?
It is, and that brings us to the structural counterbalance here, which is their capital allocation. You really have to look at what management is doing with the actual cash they generate.
Right, because they generated, what, $635 million in operating cash flow this quarter?
Yep, and $582 million in free cash flow just in Q2. And management explicitly stated they expect to use about 50% of their free cash flow to repurchase shares this year.
Oh, wow. So they have roughly $200 million slated for Q3 alone just for buybacks.
Exactly. So they are issuing new shares to the engineers to keep them happy, but simultaneously they're taking the massive cash profits they generate and buying back shares on the open market to retire them.
Which effectively neutralizes the dilution.
Oh, okay. I see the mechanism there. So when you understand that dynamic, the non-GAAP operating margin of 45.5% actually becomes a much more accurate reflection of the cash-generating power of the core business. It does.
I also keep seeing this Rule of 40 metric highlighted in the notes, and it's projected to hit roughly 63% for 2026. Can you break down how we get that number and why it actually matters for the health of the engine?
Sure. So the Rule of 40 is basically a benchmark used to evaluate the health of software companies. You simply add the revenue growth rate to the profit margin.
Oh, that's it. Just growth plus margin.
Yeah, that's it. The general consensus is that if the sum is over 40%, you have a highly sustainable, well-balanced business. But striking that balance is notoriously difficult.
Right, because usually a company is either growing revenue aggressively while losing a ton of money, or they're highly profitable, but their growth is completely stagnated.
Exactly. So for Cadence to be hitting approximately 63% means they're achieving both high growth and elite profitability simultaneously.
And if the engine is running at a 63% efficiency level, I want to know exactly what kind of fuel is being pumped into it. I mean, where is this cash actually coming from, and how reliable is it?
To figure that out, we really need to dissect their product mix and the recurring revenue model, because it's a huge part of the story.
Yeah, looking at the data, the revenue is incredibly sticky. Fully 78% of their Q2 revenue is recurring.
Which is a massive buffer.
Definitely. And breaking down the product mix, Core EDA, which stands for Electronic Design Automation, makes up 68% of total revenue. Then you have System Design and Analysis making up 17%, and Semiconductor IP sitting at 15%.
Right.
Now, I understand that 78% recurring revenue means they are operating on a subscription model, but why is it so sticky? Why don't customers just leave?
It all comes down to what EDA software actually does. You know, electronic design automation is not just a basic productivity tool like a word processor or a spreadsheet.
What is it then?
These are massively complex physics simulators and design platforms. Engineers use them to physically map out billions of microscopic transistors on a single microchip.
So it is essentially the architectural blueprint software for the modern digital age.
That's a great way to put it.
I mean, if you are constructing a 100-story skyscraper, you can't just decide halfway through the build to switch to a completely different software provider for your blueprints. The switching costs, like retraining your architects, the risk of data loss, the project delays, it would all be catastrophic.
That analogy hits the nail on the head. A semiconductor company designing the next generation of AI accelerators or mobile processors is simply not going to swap out their underlying EDA software on a whim.
It's just too embedded.
Right. The engineers spend years mastering Cadence's specific tool sets. It literally becomes the foundational infrastructure of their entire research and development department.
Wow, okay. And what about that 15% of revenue coming from semiconductor IP? What does that piece of the puzzle do?
Think of semiconductor IP, or intellectual property, as highly specialized, pre-designed digital Lego blocks.
Okay, Lego blocks. I like that.
Yeah, so instead of a chip maker spending thousands of hours designing a standard USB controller or memory interface from scratch, they just license the pre-built design, the IP, from Cadence.
And then they just drop it directly into their larger chip blueprint.
Exactly. It saves the customer a massive amount of time, and it creates another incredibly sticky, recurring revenue stream for Cadence.
Okay, so when you combine the essential EDA blueprint software with these pre-built IP Lego blocks, it seems to create a massive economic moat.
It does. It creates a structural buffer against the notorious boom and bust cycles of the broader hardware market.
Right, because when the economy slows down, consumers buy fewer laptops and smartphones.
Exactly. And chip makers respond by cutting their manufacturing budgets and letting their inventory clear out. But they do not stop their R&D.
Oh, because they have to keep designing the chips that will launch 3 years from now.
Yeah.
Or they will lose their competitive edge entirely.
Right. So even when the manufacturing side of the semiconductor industry is in a deep recession, the R&D departments just keep paying their Cadence software subscriptions.
That's a huge advantage. So let's look at exactly where those subscriptions are being paid from geographically. The Americas lead the pack at 43% of total revenue.
Which is expected.
But the number jumping off the page for me is China at 15%. And that's actually up from 12% at the end of 2025. Then you have other Asia at 20%, Europe, Middle East, and Africa at 15%, and Japan at 7%.
Yeah, that China number is definitely one to watch.
I want to circle back to that growing China number in a moment, because that feels like a vulnerability. But first, knowing they have this entrenched economic moat, how far out does their visibility actually go? Like, they raised their 2026 growth guidance to 19%, but does the pipeline actually support that?
The pipeline is perhaps the strongest part of this entire report, honestly.
Yeah.
And it is found entirely in the backlog data.
The backlog numbers are staggering. I mean, Cadence is currently sitting on a record backlog of roughly $8.1 billion.
It's massive.
To give you some historical context, that is up steadily from $7.8 billion in 2025, $6.8 billion in 2024, and $6.0 billion back in 2023.
They also estimate that revenue drawn from the beginning backlog for 2026 will make up about 65% of their total revenue for the entire year.
So an $8.1 billion backlog represents legally binding commitments from customers, right? Like the contracts are signed.
Exactly. The mechanism here is that because software is delivered over time, often through multi-year subscription agreements, Cadence cannot legally recognize all that cash as revenue on day one.
So it just sits in the backlog.
Yep, and it gets recognized incrementally as the service is actually provided month after month.
Let's do the math on that for the listener, because the sheer scale here is wild. Cadence is projecting somewhere around $6.3 billion in total revenue for the entire year of 2026. Yet they're sitting on an $8.1 billion backlog.
It's a great problem to have.
It's like an exclusive restaurant that only has the capacity to serve $6.3 million worth of food a year, but they already have $8.1 million in non-refundable reservations booked out over the next few years. They don't even need to advertise. The kitchen just has to focus entirely on executing the menu without burning the food.
Yeah, the downside protection that kind of backlog offers is phenomenal. I mean, when management knows that 65% of the year's revenue is already baked in from day one, it takes an enormous amount of pressure off the quarterly sales teams.
I bet.
And it allows the executive suite to plan their capital allocation, like those $200 million in Q3 share repurchases, with a very high degree of certainty.
And that certainty is heavily reflected in their Q3 guidance, too. I mean, they're projected between $1.595 billion and $1.625 billion in revenue for the next quarter,
Right.
with non-GAAP EPS coming in between $2.01 and $2.07. It just paints a picture of this unstoppable machine.
Well, I need to step in and temper that enthusiasm just a little bit, because the market dynamics tell a slightly different story.
How so?
An $8.1 billion backlog offers incredible protection, yes. But because Cadence has built this track record, because they have a 63% Rule of 40 metric, and because they operate with an 88% gross margin, they trade at a massive premium valuation on the open market.
Okay, so going back to the restaurant analogy, they're booked solid, but because they charge Michelin star prices, if a single dish comes out lukewarm, the critics will absolutely destroy their reputation.
Precisely. The stock market is a forward-looking mechanism. It has already priced in the $8.1 billion backlog. It has already priced in the 19% growth guidance.
So there's no room for error.
Exactly. Moving forward, simply meeting expectations is not enough to drive the valuation higher. They have to execute flawlessly. They have to integrate their recent acquisitions perfectly, and they really have to prove that their heavy investments in artificial intelligence are actually driving new incremental revenue, not just keeping them on par with competitors.
Which brings us perfectly to the reality check portion of this deep dive. If an $8.1 billion backlog makes them seemingly invincible on paper, what are the actual landmines that could blow up this execution?
There are definitely a few.
I dug into the notable risks section of the forward-looking statements, and there are a few highly specific items every retail investor needs to monitor. First, they cite macro and geopolitical risks. ongoing tensions, armed conflicts, export controls, and tariffs.
Standard, but very real.
Right. Second, there are specific regulatory and legal risks. The company notes they have ongoing obligations stemming from their July 2025 settlement agreements with the U.S. Department of Justice, the DOJ, and the Bureau of Industry and Security, the BIS.
That's a big one.
And third, execution risks, specifically integrating the pending acquisition of the Hexagon D&E business and realizing actual financial benefits from AI.
Well, the intersection of those geopolitical and regulatory risks is really where the vulnerability lies for Cadence.
Let's connect the dots here because I see a massive tension in the data. Earlier, we noted that Cadence has a 15% revenue exposure to China, and that number actually grew from 12% last year. Yet, they are explicitly flagging U.S. export controls and these recent July 2025 DOJ and BIS settlements as major risks. So, if they have an $8.1 billion backlog of signed contracts, are those contracts actually bulletproof if the U.S. government decides to tighten the screws on international trade?
They are absolutely not bulletproof. A government stroke of a pen can invalidate a signed enterprise contract overnight if national security is invoked.
Wow.
Yeah, to understand why the DOJ and the Bureau of Industry and Security are so involved with a software company, you have to understand that EDA tools are no longer just viewed as commercial products. They are classified as critical national security assets.
Because whoever controls the design software ultimately controls the global AI arms race.
Exactly. You cannot build next-generation military hardware, hypersonic missiles, or advanced artificial intelligence data centers without cutting-edge semiconductor.
And you cannot build those semiconductors without Cadence's software.
Spot on. The U.S. government knows this. The July 2025 settlements highlight that Cadence must rigorously comply with strict export controls, ensuring their most advanced tools just do not fall into the hands of sanctioned entities or foreign militaries.
Okay, so that 15% revenue exposure to China is highly precarious then. I mean, even if a Chinese tech conglomerate desperately wants to renew their multi-million-dollar Cadence subscription, the U.S. government can simply step in, revoke the export license, and pull the plug.
That is the geopolitical tightrope management has to walk right now.
It's wild.
It is fascinating that their China revenue actually grew to 15% despite the looming threat of tariffs and trade wars. I mean, it really speaks to how desperately foreign tech companies need Cadence's tools to stay relevant.
But it also means a portion of that record backlog is tethered to diplomatic relations that are entirely outside of Cadence's control.
Yes. Furthermore, when you bring in the execution risks, like integrating the new Hexagon D&E business across a global footprint, maintaining airtight compliance with the DOJ and BIS becomes a highly complex operational burden.
It's a stark reminder that no matter how deep your economic moat is, the federal government can always build a bigger bridge right over it.
The thesis for Cadence is incredibly strong, but these regulatory burdens are variables that retail investors just cannot afford to ignore. Flawless execution for a company like this isn't just about shipping bug-free code or retaining AI engineers. It is about navigating an increasingly hostile and fragmented geopolitical map.
Right. So let's bring this entire earnings recap together so you can digest exactly what this means for your portfolio. We have a software giant that just delivered a strong Q2 beat. They raised their full-year guidance for 2026, and they're boasting a staggering 88% non-GAAP gross margin.
Yeah, and they are methodically using 50% of their massive free cash flow to repurchase shares on the open market, actively neutralizing the dilution caused by the stock-based compensation they use to hoard that elite engineering talent.
Yep.
And all of this is underpinned by a structurally insulated business model. Their 78% recurring revenue relies on the fact that semiconductor R&D cannot be paused, which essentially acts as a toll booth for global innovation.
And they're operating with an $8.1 billion backlog that provides phenomenal visibility and downside protection.
But, and this is the crucial caveat, they are priced for absolute perfection.
Yep, they are navigating a geopolitical minefield with 15% of their revenue tied to a region actively targeted by U.S. export controls and DOJ oversight. So I want to leave you with a final thought to ponder as you evaluate Cadence Design Systems. With their Rule of 40 metrics soaring to an elite 63% and a backlog that completely eclipses their annual revenue, are we looking at a business that has fundamentally decoupled from the boom and bust cycle of the semiconductor industry? Or are they simply surfing the absolute peak of the AI hardware wave, destined for a brutal reality check when the global infrastructure build-out inevitably plateaus?
How you answer that question will ultimately determine if you believe their premium valuation is justified.
That is a wrap on our Q2 2026 Cadence recap. Make sure you hit follow on the show so you don't miss out on our daily no-nonsense earnings coverage. We will see you on the next deep dive.